I guess we've been saying for a while that the Fed seems trapped, but it seems like right now, more than ever it is, because we see inflation rising as well now, 4% inflation officially, the underestimate of the CPI. But your take on that inflation number, and it's like, well, where does the Fed go from here? Because if they in order to combat inflation, they can only really raise interest rates, but they definitely don't want to do that.
That won't help. That'll hurt. That will hurt certain other assets. And the main issue right now for them academically is unemployment isn't bad. It's staying the same. It's reasonable area. So there's no issue about the job market. That's one of their mandates. Well, we showed a charts of the unemployment rate and overlaid it on the stock market couple weeks ago in a report, and showed that every time the stock market tops, like .com top or the 2007 top, if you looked at unemployment, it was stable. It wasn't at high levels. It didn't give you an early warning. It didn't give the Fed an early warning. It was later, like well off the high, like 15, 20% off the stock market high. Then suddenly that data point went negative. In a way, the Fed can say, oh, look, our mandate is employed now. They know better without talking about it that the government bond market is the real issue. This is not a mortgage crisis coming up. It could be a little bit of that too, and a corporate debt crisis and a private debt crisis. But the main thing is it's a government bond crisis. The Japanese have it, and we can laugh about it, but now we got it. Jamie Dimon said, we got a government bond crisis, we're going to have to deal with it. And he didn't mean 10 years from now. And our technicals argued, no, the bond market's is already broken enough momentum indicators to tell us that we're headed back down and likely to take out the price lows we've seen over the last couple of years and the yield highs. And already, I think the yields of some of the long debt is at 2007 levels. Okay, so that's not a mandate, but the Fed is aware of it because they know that's a crescendo that will topple everything. And they control the short end of the market, but they don't control the long end. So that's the thing you got to watch. And as far as the quote inflation issue, I don't regard inflation as CPI or wholesale prices or rising commodities. That's an effect of inflation. Inflation, look at an M2 chart. There's your inflation metric. It's parabolic. Go back several decades. Federal Reserve of St. Louis has this chart, M2. Punch it up and nail it to your wall. You want to know what inflation is? It's the degradation in the money unit, the increase in the money supply, which causes prices here, there, and soon everywhere to go up. It sometimes creates stock market bubbles. And when they break, that's when all your data points go south. Right now, we argue that the place to be in terms of assets, and I don't mean the rapid explosion we expect to see in silver, but in the broad commodity complex, is the commodity complex. It is dirt cheap historically. It's technically very positive. It's not gotten headlines except for oil recently, and oil's a laggard. We had our breakout in January. It's $65 crude. The war started, early March, late February? That's when the panic buyers came in and drove oil up to 115 a couple times. Right now we're trading 90, okay? So they're getting hurt a bit. But broadly, the commodity complex looks like an investment-grade arena to be in. Grains, grain-related. Once we get a little pullback in oil, I think it's a secondary place to buy. The primary place was January, 65. But basically, the commodity complex looks like a place to be. Unleveraged, looking long-term, like out the next several years. I think it'll be the prime benefactor, other than monetary metals, of the next Fed panic, monetary excess.
Certainly. And I think, as you mentioned, there are commodities like silver, right, that are, in your view, moving to a new price range. And that is going to significantly impact the effective inflation, as you mentioned.
Their mandate of the inflation, the way they measure it. Yeah.
Right, yeah. We've already seen the real inflation, the inflation of the money supply, but it's just going to get way worse, and people are going to see the effect of that soon, it sounds like.
Yeah, I think so. And it's not because of the war. Because again, if you look at oil, yes, it exploded. and therefore help contribute to the Bloomberg's rise. But we got bullish on Bloomberg Commodity Index, which is a well-balanced index. It's not 50% energy, okay? It broke out in October of last year, way before the war ever, and its price was 106.50 was our breakout level, okay? We're trading to 130 right now. That's a pullback even, okay? Oil only contributed starting really in February-March period, after the February close. Bloomberg had already been going up, and it had already reached like 120 to 130 before oil even woke up, okay? So although everybody likes to blame, quote, inflation on the oil situation, but it's not. It's broader. It's much broader. And it's non-headline based. It's not like everything's going up because of a headline. Oil did. And therefore, the guys who bought that headline are going to get hurt. But it won't change the bullish trend on oil. Oil trend, again, turned positive at 65. I would not be shocked to see it down to 80 at some point. And there's a point at which you could buy that pullback. But because it got loaded up with emotional buyers, and they usually get gut kicked. Anyway, but I think that's an asset category to be in that will benefit from the next further and even more accelerated monetary expansion that the Fed will engage in. Instead of going into stocks, the bloated bubble, investors will put it elsewhere. And I think that's where it's going. That's what our technical signals indicate.